Good afternoon. Welcome to this REST Super workshop. I'm Leilani Weir and I'm the Head of Responsible Investment and Sustainability at REST Super. And I'll be leading you through this workshop today on Help Save the Planet and Your Pocket. It's an absolute pleasure to join you, and I'd just like to help you with some housekeeping to get this session best for you. In your screen, you'll probably see a series of boxes, just to let you know that you can hit the right-hand corner of those boxes to make it bigger, so you can make the slide presentation bigger, or any of the other boxes you can see bigger. You've also got some little icons at the bottom of your screen where you can close the boxes as well, so hopefully that helps. And also in your visual, you should be able to see some links to the REST website, and that will also take you to our just recently released Sustainability, Responsible Investment and Climate Change supplement. So welcome. And I would also like to acknowledge the lands on which I bring this to you. I'm currently sitting in the lands of the Gadigal people of the Eora Nation, and I'd like to acknowledge all traditional owners across Australia and pay my respects. So for this workshop, we're going to have a tour through REST's approach to responsible investment. We'll then have a look at how we're approaching climate change risks and opportunities in the investment portfolios. And then we'll do a deep dive into the sustainable growth option, which is a wonderful story about how we've engaged with you to build that option. So I'm really looking forward to sharing this time with you. So let's first have a look at how we approach responsible investment. Okay, so what is responsible investment, first of all? Let's explore that. So at REST, we believe that responsible investment adds value. And it adds value because it looks at the consideration of environmental, social, and governance factors into our investment process. Now, these factors are vast and varied. Environmental factors that we will look at as in our decision-making process could be climate change, greenhouse gas emissions, otherwise known as carbon emissions, the energy efficiency of an asset, how waste is managed at an asset, if there's any pollution to land, air or water, and also the water availability for the asset and in the region that we're investing. We also look at social considerations. So these include modern slavery, human rights, Indigenous rights. We'll also look at workforce issues within companies and assets. For example, fair pay, health and safety and well-being, and also diversity and equal opportunities. And finally, in our governance considerations, we particularly look at corporate governance. What's the culture like? How are they conducting themselves when they do business? And are they accountable for the decisions being made? We also look at board diversity and composition, and also executive remuneration. Now, this all helps with risk-adjusted returns, but we also know that you, our members, are interested in these factors as well. So we surveyed members in 2019, and in that round of surveying, we found out that 4 out of 5 of you believe that a super fund has a responsibility to society when it comes to investing. So with responsible investment so far, we've got the ESG considerations for risk-adjusted returns, and we've got our member preferences. But there's also some really excellent research out there that really moves us along into more further and deeper responsible investment in our portfolio. And this includes a number of studies which I'll just run through. So REST is a UN PRI signatory, and that means the United Nations Principles of Responsible Investment. And a recent study has found that signatories to the UN PRI have higher returns and lower costs than non-PRI signatories. Another study that was done quite a few years ago now found that firms that improve their sustainability performance normally outperform their competitors. A further academic study, which just came out last year, actually looked at how engagement, and that's active ownership through environmental, social governance factors with companies, actually enhances shareholder value and also helps control that downside risk, which is really important to long-term investment portfolios. And then finally, a real passion at Rest is gender diversity. And a Credit Suisse study actually found that out of 3,000 listed companies, that companies with gender diverse leadership teams are linked to a higher share price. So these are fairly compelling reasons as to why we're really committed to responsible investment at Rest. But now let's look at one particular area of responsible investment that I mentioned earlier in the presentation. And this is looking at our approach to climate change. So at the end of last year, Rest actually set a net zero by 2050 target for the fund, and that's net zero emissions. Now, we did this for a number of reasons, and I'm going to go through that now. First of all, when we surveyed you, our members, we actually found out that 76% of you would prefer to avoid or oppose investing in companies with a recent record of environmental damage. We liken environmental damage to climate change, which is emissions to the atmosphere creating a changing environment. So therefore, we clearly heard that this was an area of concern for you and a key component of our responsible investment. But we also decided to put some numbers to this. And what we ended up doing is we looked at the International Energy Agency's possible future scenarios. Now, these are fascinating scenarios that look into the future of possible ways energy markets could shift. So we looked at one scenario where the world just stays on the track that we are on, and then we looked at another scenario where the world actually acts to keep global temperatures well below 2 degrees. We then overlaid that for a Rest member that was invested in the Rest Core Strategy option. Now, for a member who was 48 today, that has an account balance of $67,000 and earns a salary of $48,000 a year, we actually found out that that member is expected to be $50,000 better off in retirement if the world acts to keep global temperatures well below 2 degrees by 2100, which achieves the goals of the Paris Agreement. These were pretty compelling reasons for us to go for that net zero ambition. But what does net zero mean? Okay, so for an investor, net zero is when we look at our entire investment portfolio and look to calculate the emissions in that portfolio. We are then looking to get all of those emissions to zero, but it's net zero because in some parts of our portfolio, we may actually have assets that actually remove emissions from the atmosphere, whether that be through technology or natural means. So this is what we're aiming for, to shift the portfolio over the next 30 years to 2050 to net zero. But how would that look like at an economy-wide scale, and what would be the investment opportunities? So on the next slide, we're looking at an International Energy Agency scenario where the world could actually achieve net zero emissions by 2050. Now, this is interesting for us as investors entrusted with your retirement savings because this signals investment opportunities in the future for the low carbon transition. These investment opportunities will be the global car sales being electric and the investments into that new emerging industry. And it could also be investments into low emissions fuels for aviation. There are plenty of possibilities in this scenario, and this is what we're always keeping abreast of as the world transitions. But this is quite longer term, looking at 30 years ahead. So let's have a look what we're doing now. So earlier this year, after we set our ambition, we developed a net zero by 2050 roadmap, and that roadmap's available on our website. And that roadmap has got 6 key climate change measures in it. The first one that I'd like to quickly run through is thermal coal. We're looking at winding down exposure to thermal coal by the end of this year for companies where revenues are greater than 10% from thermal coal mining. And we will only do that if the company doesn't have a net zero by 2050 target or is not signed up to science-based targets. We're doing this because thermal coal is well known as a stranded asset. Now, stranded assets are non-renewable resources that are in the ground that are likely to lose value over the coming transition. We also are advocating for a just transition. So that means workers in these industries, we're advocating for them to be supported as the economy shifts. We also advocate for economy-wide reduction of 45% by 2030 emissions. This is based on 2005 levels. And this will also have very positive effects in reducing emissions in our portfolio. We have a $2 billion target for investments in renewable energy and low carbon assets by 2025. And also we have an ambition for our direct property portfolio to be net zero in operation by 2030. One of our really exciting measures is our impact investing and looking to allocate 1% of our funds under management to impact investments. These are enhanced responsible investments that at the very outset have a members' best financial interest with that return, but also a secondary aim with environmental and social outcomes right from the start of the investment. And then we will also be doing our annual climate stress testing of the portfolio to make sure that we're always testing for that figure that I mentioned before, where we could expect to see one of our members being 50,000 better off in that scenario. So now let's have a look at the sustainable growth option. This option is absolutely the best bit of my evening tonight, is to be able to share this with you. So this option launched on the 29th of March and this year, and it's the newest option in our investment menu. So you'll see that we've got the core strategy, the structured options, and the member tailored options. These are all available to have a look at on our website, and you can see that sustainable growth fits in our structured options. It's also symbolised by the echidna, so you may have seen some posts on social media with an echidna, and that will help you recognise the option when we're talking about it. But this option is so exciting for me is because members helped shape this option. So when we surveyed members in 2019, we got a strong signal that there was interest in a sustainable option. Then we went back out to members in 2020 and you told us what you would like to avoid investments in and also what you'd like to invest in. So you told us that we'd like to avoid investments in fossil fuels, environmental damage and palm oil, which is associated with deforestation. You told us companies that are associated with animal cruelty or unethical supply chains or gender discrimination in the workplace and excessive executive remuneration would not be something you would want to invest in. And then also companies associated with gambling, tobacco and controversial munitions is also another area to exclude. But that still leaves us with a lot of investment universe. So what we then did is we positively tilted the portfolio to the leaders who are leaders in environmental sustainability, show respect for human rights and equitable societies, and have accountable governance and transparency. And most interestingly too, we also looked at strict criteria for infrastructure and property assets into this option. So these assets have to reach certain hurdles around renewables and low carbon specifications, being green buildings, and also being able to be sustainable infrastructure. But really, how does it differ from for one example, the core strategy. So both options have responsible investment integrated into them, but this shows a nice difference in the options for you. So both have ESG integration, but the negative exclusions in sustainable growth are sitting at 10 versus core strategy at 2. We also have norms-based screening in sustainable growth. And what that is looking at companies who have subscribed to the United Nations Global Compact's 10 sustainability principles. And so companies will have to meet that hurdle as well in sustainable growth. Active ownership happens in both of them. That's how we engage with companies and asset owners on ESG factors. And also, the sustainable growth has that positive screening and that real intentional sustainability themed investing that I mentioned just before. So what you also told us when we were designing this option is that you would like low fees and high returns. So we're very proud to say that 6 months after launch, we are offering low fees. In fact, our sustainable growth option has up to 48% lower fees than the average ethical and sustainable option on the market. But also, let's have a look at the returns since inception. So the returns for this option are looking at 8.51% for the 6 months to the 30th September 2020 for the super option. But also, if we look at the quarterly returns to other like investment options in the market, we're actually sitting higher at 2.34% for that quarter. Now, the difference is because of the time period we're measuring those returns with that 6 months at the top and the quarter at the bottom on that slide. So we listened, we heard you, you gave us great feedback as we designed this option, and I'll move on now to showing you where you can actually find out more. So please do have a look on rest.com for more information. You'll also find our sustainability, responsible investment and climate change supplement on the website. And I'm really now very much looking forward to your questions. So hopefully you've got some ready for me. And what I'm going to do now is just open my Q&A box, and I will start to have some questions come through. So I can see a question here. Okay, so the first question is, how do I know what the sustainable growth option is invested in? Okay, so if you have a look on the REST website, you'll notice that in the How We Invest section of our website, there is a whole lot of our options and links to all the assets that each option is invested in. So sustainable growth has got exposure to equities, bonds, property, infrastructure, cash, and you'll be able to see a PDF that shows all the assets the sustainable growth is invested in on our website. So I'd really encourage you to go there and have a look. It can really connect you to whichever option that you are choosing to be in. I'll just have a look for the next question. Okay, so the next question is, after Glasgow and the watering down, do you think the goals of the Paris Agreement can actually be achieved? This is a really good question. So for those of you in the audience who don't know what Glasgow is, so Glasgow actually is a town in Scotland, but it just hosted the COP26 International Climate Change Conference. And what they were aiming to do at that conference was strengthen the goals of the Paris Agreement. Now, the Paris Agreement happened in Paris in 2015 and was all about keeping temperatures well below 2 degrees. I would say that the outcome from Glasgow, which is now called the Glasgow Pact, is actually a positive. It reaffirmed the goals of the Paris Agreement and also was very clear about the need to keep global temperatures to 1.5 degrees by the end of the century. So there will be another climate conference next year in Egypt. As investors, we watch these conferences very closely because they do have impacts and ripple effects for our investment portfolios. Just having a look at the next question now. Okay, so the next question is, REST uses a lot of external managers. How do you know that they are integrating ESG into the portfolio? This is another really good question. Okay, so by external managers, what this means is, as an asset owner, we use an external investment manager to invest funds on our behalf. And what we actually do about that is we engage with these investment managers all of the time. And our responsible investment policy, which is available on our website, the Responsible Investments website, actually sets out how we do that. And what we do is we conduct a deep dive into the investment manager's approach to ESG, how they consider ESG on an annual basis, and we also conduct ongoing monitoring. And it's a constant dialogue to always make sure that we're bringing our member voice to our investment managers alongside those risk-adjusted returns. So this is a constant cyclical feedback loop of making sure we're always getting the ESG risks that are a high priority to us addressed in investment portfolios. Okay, I think I've got another question here. We're getting through quite a few. This is good. Okay, the next question that I can see is, will you also invest in renewables? And when will you end your investment in coal? Okay, a terrific question. So I'll answer the first part of that question first about, will you also invest in renewables? So REST is already invested in renewables, and we have a really good exposure. In our listed equities portfolio, which is a significant part of our investment portfolio, we have just over $1 billion listed in what MSCI classifies as low carbon solutions companies. So that's in our listed area. And then in our private markets and unlisted, we've actually, at the end of 30 June 2021, we had just over 900 million, around about 940 million invested in renewable assets. So this is showing the growth in this field and how our investment portfolio is changing. The next part of that question is, when will you end your investment in coal? Now, I'm going to answer this question in two parts. So coal is can be thermal coal, or it can be metallurgical coal. Thermal coal is what's used in energy at a coal-fired power station, and metallurgical coal is used in steelmaking. Now, thermal coal is what we are going to be divesting from with that 10% revenue threshold for thermal coal mining by the end of this year. However, to support the low carbon transition, we need to work with companies to gradually change their business models. So if a company is well diversified and still has the thermal coal exposure under that 10%, we will actually be looking at what else, and we're doing a lot of research on these companies, is if they've got an answer to the low carbon economy that we are looking to invest in, therefore we won't invest. So hopefully that helps with that question. This is all about us as investors making sure we don't have stranded asset risk in our portfolio, but we're also investing in the low carbon economy. I'm just going to check if we've got any more questions here. Okay, here's a question. How does the fee of the sustainable growth option compare with the core option? Okay, so the fee for the sustainable growth option is 0.36%, and it actually comes in just a little bit lower than the core strategy option. So I'd really encourage you to talk with look on our website, talk with the REST advisor on any of these fee-related questions, because the financial advisors can be really helpful in helping you make choices with your retirement savings. Okay, just one more question here. I can see. Okay, great. I'll just read this out so I can share it with everybody. With environmental, social and governance, does one take more precedent over the others, or are they equally important? What a fantastic question. Okay, so the way that we look at this is when we're making an investment decision, we will consider all of the ESG factors that may apply to either that sector, that geography, or that particular company and asset, because there can be nuances. What we'll often look for, and what we've always traditionally looked for as investors, is governance. Having good governance at a company is very, very helpful to making sure that the others flow. However, that doesn't mean that it takes priority, because what we see when we're making investment decisions is we look for material ESG risks. So material means that there might be some risks that are higher than others. And for an example, if we're assessing an asset in perhaps, say, the healthcare industry, there are certain ESG risks that could take priority for that sector than, say, perhaps another sector that won't have the same risks. Another example is if we're assessing a factory or something along those lines where the risks of health and safety are higher. Infrastructure, for example, will also prioritise some risks that are known to the industry and sector. However, it really is about looking at all the risks, making sure we've assessed the material risks and that there are action plans in place for them to be managed. So in answer to your question, they don't take precedence. We take a material, pragmatic view in managing those risks and looking at the sector or the industry in which the asset or company is operating in. I'm just looking for any more questions that might be coming through. Okay. I'm just letting you know that I've got, oh yes, okay, sorry, I can see a few more. Okay, do you think the sustainable investment will continue to grow, or is it just a current trend? These questions are great. Thank you so much for being so engaged in this session. So in short, I don't think it is just a current trend. I think ESG has become pervasive, and it is within there is a global movement. The Glasgow Pact that I spoke about earlier, the commitments that countries are making, continue to make, I think is all a growing trend. And a personal anecdote, I've been working in this field for over 20 years, and I have never seen sustainable investment with the momentum that it has at the moment. And I do think it will continue, just because it helps so much with risk-adjusted returns and making sure that we're really protecting the investment portfolios into the future for your retirement savings. Okay, just looking for one more question if we've got time. Actually, I think we are at time. So I am going to thank you so much for joining me for this session. It's been an absolute pleasure to share with you REST's approach to responsible investment, climate change, to share with you our newest option on our investment menu. And I wish you a truly good evening and encourage you to keep in touch with REST and ask us questions. And thank you very much for joining me.